All right, Warren Thomas, good to see you, sir.
Nice to see you too.
Good. Uh, this is it, should we consider this the a third or fourth episode together, going over different aspects of real estate and DSTs and 1031 exchanges?
Yeah, well, why don't we consider it a fourth and then go for number five, six, and seven too?
Let's do it. We're getting good traction. A lot of people in the audience that gets good feedback, so I'm looking forward to it. And this is just recorded, so we'll put up a disclosure and everything. So we'll skip that part. But like always, I'll introduce you to everybody, just in case this is their first time, and then we'll jump into talking a little bit about triple net and net lease properties. Sound
Okay.
good?
Yep.
All right. All right. So Warren, he is the co-founder of ExchangeRight, co-founded in 2012. And growing it into a leading provider of diversified real estate, DST, and REIT investments, serving more than 8,900 investors. Under his leadership, the firm has grown to over 6.3 billion in assets under management, diversified across more than 1,300 properties and 47 states. All ExchangeRight offerings have met or exceeded cash flow projections since the company's inception. With over 40 years of experience as a CPA and over 30 years as an active commercial real estate investor, Warren specializes in tax-efficient investment strategies, estate planning, and real estate advisory services. He holds a bachelor's in business from Biola University, a master's in taxation from Golden Gate University, and maintains his Series 6, 7, 22, 24, 39, 63, 66, and 79 security licenses. Thanks for being here, Warren.
Thank you, Stephen.
All right. Now, I'm glad we're talking about net lease real estate today because usually when people ask us about 1031 exchanges, one of the main things they talk about, in addition to DSTs, what we do, and TICs, is buying their own net lease or triple net property. And more often than not, there's a lot more that goes into it than they anticipate. And as somebody that's overseen billions in the acquisition and management of this type of real estate asset class. I think you're the man to give them some education on kind of what your experience has been and kind of what the lessons learned from those experiences.
Great, great. Thank you, Steve. There's a lot of lessons that have been learned, and I'm sure there'll be many more that will still be learned. And happy to share that
Absolutely.
with you.
We'll just get the wave tops on this call, then maybe we can dive in later on too. And to really start us out, I'd really like to talk about kind of what goes into buying net lease. But I guess before we do, maybe you can help us understand what triple net means first, and then go into what you look for in a triple net or net lease property.
You bet. Okay. Yeah, we'll start there because a lot of times folks will use the term triple net, not really understanding what it is. Or you'll see a broker that is trying to sell somebody something that they're calling a triple net property, and it's actually a net lease property that is not really triple net. So I'm going to kind of start with some definitions of what is and what isn't. Under a pure triple net property, the tenant or the tenant that's occupying the property is actually responsible for all the operating expenses on the property. And they even can be responsible to the point of if that building were damaged or destroyed through a hurricane or a fire, as we've had recently, both on the East and West Coast, the tenant could be responsible for even rebuilding and paying the rent while they're going through that process of rebuilding. So that would be illustrative of a triple net. So it's not only paying the insurance, the utilities, the taxes, the rent to you, the repairs, but having responsibility for really everything on the property. Now, again, sometimes a broker will say, hey, I'm selling triple net properties, but what they're really selling is a double net property. So, double net property, you have to be careful with those to understand what isn't being covered. Triple net, you assume it's everything, and you look at your underwriting with that as your first assumption, and then you make sure that that's really what it is. But a double net, you're going to be responsible for the mechanical, the parking lot, the roof, the structure. And so if you're going to buy that type of property, you need to make sure you've done your due diligence on the building itself and on all of those components so you're aware, when will that roof wear out? What type of maintenance is really required for that parking lot or the lighting system in the parking lot? And how old is the air conditioner, the heating unit? What does the plumbing look like inside the building? Because under a double net, or even what we might say is a double net plus, you're probably going to be responsible for that if you buy that type of property. Those are the common definitions of what a net lease property is. It's either double net or triple net or something a little bit in between.
Some kind of combination. Now, one interesting thing that I've come across is that triple nets may be a true triple net property, but there's how you get paid or the way the expenses get reimbursed can be kind of funny sometimes. Sometimes you have to go out of pocket, pay the expenses, and then get reimbursed later. Have you run into many of those situations?
Yeah, there's every net lease property that you buy, you have to first understand what the rental contract is, because the rental contract will tell you whether the tenant is going to be responsible. And let me give you a couple examples, because you just led with this. It's common even in a triple net scenario where the tenant is responsible, that you as the landlord will pay the taxes and then get reimbursed from the tenant. Or you as the landlord will pay the insurance and then get reimbursed by the tenant. And so it doesn't necessarily mean, just because it's triple net, that everything is going to be paid by the tenant all the time. You need to look at that lease, because if you thought you were going to get out of having to write a check and all you're going to get is a direct deposit into your bank account, it might not be quite as easy as you think. Okay, so you
Yeah.
need to be aware of that. And then there'll be certain maintenance items that also could follow that same methodology. And sometimes, your tenants, they may not put the same work into maintaining your property, even though they're responsible for it. So I'll let that be maybe a future little discussion we can get into here.
Yeah.
But yeah, a triple net doesn't necessarily mean that you never write a check.
Yeah, and they may not have the urgency to pay you as you may have to pay the IRS or any type of maintenance issue or things like that, which I've seen and come across. Well, that's great. So one of the things that I'd really like your insight on, because ExchangeRight, in our opinion at RealtyMogul, does a pretty thorough job of due diligence. And we actually have our due diligence loves calling you guys because you have good
Yes.
conversations with if we find something we don't understand or we think it might be a red flag, we call you guys and you're more than happy to go over all those items in the due diligence with us. And so what are the steps that you take in doing due diligence on your property, on your net lease properties before you buy them?
Yeah, so when we look at buying a net lease property, we have sources that I think the typical investor may have a hard time finding, for property, sources of property. We go after properties that may or may not be listed. They may not be on Marcus Millichap's list or C.B. Richard Ellis's list, because we're going to go and we're going to find those folks that might want to might be willing to sell, but they haven't bothered to list. So we're getting sources there. We're also getting sources of property from developers that are building. And sometimes I will buy ahead 10 or 20 properties that are in the process of being constructed over the next 1 to 2 years. So, having that ability where we can pre-vet not only the tenant, but the location and how they're being built. And sometimes, what are they being built out of? What kind of construction is being used in this building? So sometimes we get that look ahead of time. Most of the time, we're going to be buying a building that's already constructed, and we're going to be buying it subject to a lease. And so when we start to do due diligence, I want to know, first of all, who's behind the lease, right? Is
Yeah,
it is it a franchise where it's really a mom and pop franchise? Yeah, they might own 3 properties or they might own 20 properties, but at the end of the day, it's not the same as having a investment grade credit tenant that's being tracked by S&P and Moody's and Fitch, credit rating agencies,
right.
and every time they come out investment grade. I want that behind my lease. So credit is a starting point. right? Always looking at the credit and always looking at that lease and understanding who's behind this lease, what credit's behind it, what are the terms of the lease, what are they responsible for, what are you responsible for. That's getting into kind of the basics of where you just begin. Then you start to consider, well, will I make an offer on this particular property? And we have a pretty good idea already. We own 1,350 properties across the country, and I'll buy as much as $100 million worth of property every 75 days.
Jeez.
Most of your listeners are just not doing that, right?
Right.
So if it's I'll say Tractor Supply, for instance, Tractor Supply, big national company, we're actually their landlord of the year last year. So, they respect us, we respect them, and that may give us an opportunity to see properties before others would. It certainly gives us the opportunity to understand what should be in the contract, what the demographics need to look like. And that's kind of a more direct answer to what you're asking, Stephen, because when we do due diligence on a property, yes, I want to understand the lease. I want to understand the tenant and the credit. And then I want to understand the particulars of that location because it's still a location issue. And so I'm looking at crime, and a lot of your listeners, they'll buy a net lease property, but they've never really looked at, well, what's the crime around the area look
Yeah.
like? What's the traffic count that's going by these properties every day? What are the demographics? What's the community look like? What's their average income? Is the average income the right income for this particular tenant that you're going to have inside your building? Because a Tractor Supply doesn't look for the same demographic as a CVS or something like
Right.
that, right? It's all different. So that's a beginning of the picture, but I'll let you ask more about that because there's so many directions we could go with it.
Yeah, one of the things that's been really interesting as we look at properties or buy properties is going through the lease audits and the estoppels and the surveys and things like that. It's a pretty intense process. And so one thing that I've noticed that some of our retail investors do when they buy triple net, they just think that all leases are the same. Say, hey, it's a triple
Yes.
net. Is it an absolute triple net? And sometimes even the OM that they review is wrong. And so I always recommend that they get a lawyer to read through those lease agreements and get the estoppel and everything like
That's
that.
right.
And just wanted to make sure, just kind of get your insight or maybe some things that you've seen pop up on a regular basis that you would remind people to look for.
Yeah, I think you've said it, an estoppel. We won't buy until we get that word back from the tenant that they're happy with the building. And I need that, I need to make sure that we're not getting into something where we don't have a really solid lease contract. You're going to look at, ingress, egress, make sure there aren't restrictions on the ability of both your customer to get in and out of the property and your service trucks, inventory providers for that particular tenant. They've got to be able to get in and out of that property. You want to look at, again, the credit rating of the tenant because credit rating is going to perhaps affect the financing that you're going to be able to get from a bank. And you're in the 1031 business, and a lot of the investors that are coming in, or at least looking at triple nets, they're coming out of something that had debt on it, right? They might be selling a rental property and it might have modest debt, but they're going to need to buy something of equivalent value. And so they're likely going to need debt. So what does that mean to the credit of that lease? Also, the lease itself, Steve, when you look at a lease, I've seen this so many times. Let's say they say, we've got a 10 or a 20-year lease. And what they really meant was, oh, we had a 10-year lease, but it's down to 6.
Right.
And it's got multiple 5-year options, but those options are at the option of the tenant, not at the option of the owner, right? And sometimes I've seen it where 20-year lease and, they're down to 7, they're down to 4 years with multiple options, and yet the brokers are still selling it as a 20-year lease property. So it's ridiculous, right? And that's important for your financing. but it's really important for your security. Then you also want to look at, well, what kind of rent bumps do you have inside the contract, right? Because triple net properties, the more credit worthy the tenant, the flatter the leases tend to be.
Mhm.
So if you're investigating a property that has really high rent bumps, either annually or every few years, but they're pretty high, you need to take a hard look at the credit because usually that tenant is a bad tenant. And that's why they've got those big rent bumps inside their contract, right?
Yeah.
If they're an investment grade credit tenant, they know what they're doing up front and they know that they're attractive as an occupant of your building, and they're going to have more modest rent bumps built into the contract because they're not dummies. They take advantage of their credit strength.
Right. Right. And you said something really interesting about how where you are in the lease is important for financing and for your
Yes.
security. Can you explain to our audience why that's important and why it's important that there may be advertising as a 10 or 20-year lease, but if you have a shorter lease, that's how that impacts your
Yeah.
security by the value of the building and how the bank is going to look at it.
Yeah, yeah. So the banks are, they're always going to be self-protective and they do like very strong credit, triple net or even double net plus properties. So they're fine with that. And but as a tenant, or I'm sorry, as an owner, you're going to look at the loans and you may be surprised because often if you are a small owner of net lease property, the loans that you get from the bank are generally going to be recourse financing, not the non-recourse. So recourse means something goes wrong, that tenant stops paying and they can come back to you and you can actually be liable for the building, even though the building maybe you have to give it back to the bank in foreclosure. So you're liable for the building, but on top of that, you're liable out of your personal account to make up for whatever that building doesn't generate if it went that route, right? So
Yeah.
the longer the lease term, the stronger the credit, the more likely the banks are going to give you non-recourse financing, right? And non-recourse means, yes, they can come against your building, but they can't come against you. And that actually is an advantage to the DST structure in that we won't use recourse financing ever. We'll only go non-recourse. And the strength of your investor's tenant, if they're going to buy their own property, then they're going to probably be restricted to not be able to finance more than 50%, maybe 60% on a non-recourse basis. Anything over that, you can bet it's going to be a recourse financing event for them.
And how difficult is it right now for individuals to go out and get financing for these properties?
It's generally difficult. And if we look back 3 years and 4, 5, 6 years ago, the interest rates were down low enough to where banks were more interested. Now, of course, banks are interested at any rate. They don't care, right? Because as long as they think there's credit worthiness in your personal portfolio to pay that payment, then they're going to rely upon your personal portfolio. They're also going to rely upon the credit strength of that tenant, but it made much more sense 3 or 4 years ago when interest rates were in the fours compared to today. You're going to
Yeah.
find interest rates might be in the sixes or even sevens for the smaller investor.
Right. And one of the things that's kind of scary that a lot of my clients' brokers don't tell them about is the fact that the net lease asset is a depreciating asset, and which is scary if it's recourse because they could be underwater towards the end of that lease on that property. And then it's really important for them to have the negotiating power to renegotiate the lease and extend it again. So maybe you can talk a little bit about your experience negotiating with these Fortune 500 companies to get those lease extended.
Yeah, yeah. So I think part of what you're leaning towards here is when you get into a single net lease property, and let's say it's a 15-year lease initially with multiple 5-year options, right? But you said it's a depreciating asset. I agree with you on that. In general, when you buy that 15-year asset, the value of that building theoretically is going down every year because the guaranteed lease period is declining every year. When you bought it, it was 15 years. 5 years into it, you've only got 10 years guaranteed of additional years of payment, right? And so as you start to get down below 10 years to 7 years and 4 years, the risk of that client not goes up, and therefore the value theoretically goes down. Now, the offset to that is rental increases, right? So when rent goes up from year to year, or it's common that it might be flat for 5 years and then a 10% rent bump every 5 years thereafter, that will push the value of your property up. So we've got two things going on. We've got a declining lease term, but we've got an increasing rental stream. And the challenge here is you don't want to be the guy that was caught with not being able to renew your lease. Even though you got an increasing rental stream, if you happen to be the one owner that didn't get the renewal,
Yeah.
then you're kind of in hot water there, because now you have a building and you're out there searching for a new tenant. And you may or may not be successful in getting the same credit quality of a tenant when you're out there looking for them. So it's important to really do your homework and your due diligence, both on the tenant itself, but also on the location, on the sales, on the car counts, on all of those things that will determine whether or not this is a keeper and you're going to get a renewal of your lease term. So that's part of the picture that we have to look at. And you can start that if you're going after the credit-worthy tenants. They pretty much all file 10Qs and 10Ks with the SEC, and they pretty much all also have stats published as to what is their lease renewal rates. And I love to,
Interesting.
yeah, so I love to stay with those investment grade credit tenants that have renewal rates on their leases up in the 98% range, because
Okay.
then you just decrease the risk that you're going to be, caught with property that won't renew.
And that's
And
called
then
a 10Q and a C. Is that
a
what's that for?
10K or a
Okay.
10Q, they're filed with the SEC. They're filed by publicly reporting entities. So
Okay.
you
So
can
that would
look at.
just be publicly traded companies are the only ones that are filing those.
That's right. And those
Okay.
are the ones that are credit worthy.
Hmm.
Right? If you're going to do a mom and pop franchise, you're not going to have access to that kind of data. And it's so important that you go through that work if you're going to choose to buy one or more, single properties. What you can do with your business and with my business is you can diversify amongst DST. Or in one DST, I might have 15 properties. So I'm theoretically de-risking my lease renewal risk every time I bring out a new DST. So, yeah, so there's ways to work with it, but the best way to start is, if you're going to buy your own property, is understand location, understand your contract, understand your building, which we didn't get into yet, Steve, but that's the other thing is, how many of your investors that are buying their own net lease property have hired the right professionals to do a building inspection, a full engineering report that looks ahead for the next 12 years on all the costs that are anticipated to come up. So that's one thing you need.
Not many, because all those different reports are expensive, and if you're not buying at scale like you are, it kind of eats into all the costs. Go out there, walk the property, pay for all those engineering reports and estoppels and
Yeah,
surveys and so forth.
yeah. But those are important. So
Yeah,
the surveys, the engineering report, the environmental
environmental
report,
report. Yeah.
and obviously if you're working with a lender because you had to, because your building wasn't paid off, so you need to put a loan on the new purchase, they're going to require the appraisal. They're going to require the environmental reports. But some of the other reports, they're not going to. If they got the appraisal and the environmental, they're probably going to be happy. But you shouldn't stop there. And yeah, they cost a little bit of money, but it's worthwhile.
Now you talk a lot about the creditworthiness of the tenant and the financing and how the bank is more willing to lend on a creditworthy tenant. But if that tenant leaves, then is the bank going to require you to re-tenant with someone that is of equal balance sheet?
Right. So, first off, you're never going to get to that point. The reason why is the bank is not going to give you a 30-year mortgage or a 20-year mortgage like you're used to on your personal residence. What the bank is going to do is give you somewhere from a 5-year to a 10-year mortgage. And guess the first thing they're going to look at is how much debt you're carrying compared to your purchase price and what's the credit worthiness of the tenant, right? And they're going to limit the amount of debt you can have based on that. And you're never going to get the opportunity to see that lease expire and the tenant move out.
Oh,
At that
interesting.
point, your loan will have been called due. They
So
might,
you
if
have to
you're,
refinance. You have to plan to refinance.
you have to plan to refinance that, yes.
Man,
Or you go into an amortizing debt situation up front where you're amortizing that debt down. So by the time that 7-year or 10-year loan comes up, it's gone. Or it's so immaterial you don't care.
yeah, interesting. Okay. And then what if you refinance? You're in a 10-year lease, you refinance at 7 years, and then the tenant doesn't renew. So you go get someone else. How involved is the bank in that process?
Again, what you just outlined is you started with a 10-year deal with a 7-year loan, and you
Yeah.
get to the end of the 7-year and you're refinancing. Well, guess what? That refinance, that bank's not going to go more than 3 years.
Oh, geez. Oh,
Yeah, yeah. See, so you're
yeah. Got it.
stuck, right?
Yeah.
Or they come back and say, Steve, you've got a really deep pocket. Let's go ahead and you pledge something else to back up this lease,
Got it.
right? Right.
That's getting pretty dangerous then to be concentrated in a single asset like that.
It could be.
Yeah, that's that's usually why I tell my tenant or clients, I say, triple net might not be the best option for you if you want to go passive, unless you're doing it in a DST and you can diversify, because that's a lot of concentration risk and they don't work like residential.
Yeah, no, and I think what's often happened, and this is, I can tell you this, I can pull out illustration after illustration, where we've been called by a financial advisor whose investor has bought something, some triple net, maybe it's a Dollar General, maybe it's a Walgreens or so, whatever it is. And we hear about it a little bit after the fact, and we get the question of, what do you think of this property? And I look back in my files and I go, well, we looked at that property 7 months ago,
Yeah,
and the traffic count isn't any good. The lease term, there's a problem with that. The building itself, we've already vetted these.
right.
What you end up finding is that investors typically are buying, and I don't want to say this across the board because you've got smart investors, but a lot of investors are buying the wrong properties that have been overlooked. A really pertinent example would be Dollar General stores. If you buy the right Dollar General stores, you can do very well with that credit. They're very good credit, right? So you could do really well holding Dollar General. But there was a portfolio of quote unquote beer and bait shops. I've told you this before.
Yeah.
And, I don't want to own a Dollar General that's in a tiny little market. And these Dollar Generals were up in the Great Lakes region, and I'm just not interested in them because they don't have the population, the traffic count, the sales that we need to know they're going to be open or to have a very high probability that they will renew their
Yeah.
leases so that they fall under that 98% that'll renew.
Which is funny because those are typically the ones that a lot of retail investors go after because maybe they're only a couple $1 million
That's right.
and they're cash flowing at 7%, where if you get one in more of a concentrated area, it's not going to look as attractive from a cash flow standpoint. And it's probably going to be more expensive than they can afford. So they're
That's
going
right.
for those out in the boonies.
And the credit behind them is the same credit, right?
Right.
The Dollar General in the boonies, as we say, has got the same credit rating, but the cap rate is higher, so the cash flow would be higher because the risk is higher. And I would just, for me and for my portfolios, I don't want the higher risk because my investor is a retiree for the most part or a pre-retiree, and they're looking for stability. So I don't want that risk. A small investor probably doesn't really want the risk either, but they may not understand the risk.
Well, their
Yeah.
broker's telling them that, hey, it's a credit rated tenant, 10-year lease, 7% cash flow. You can't go wrong. And then, which they're right until something goes wrong.
Yeah.
Can you tell me what your experience has been like renewing leases? I've only heard kind of negative stories from clients that have gone into negotiations with big old Fortune 500 companies, and they're just this one man shop doing their best, and they get beat up. And sometimes they end up with
Yes.
a contract that is worse than it was 10 years ago. And
Very
obviously,
likely.
inflation has gone up. And so, how do you deal with that? Obviously, you're much larger and have lawyers on staff. And so you have a little more power, a lot more power behind you. But what's been your experience?
Yeah, I'll start with some of the tenants that are really good triple net, double net tenants, real good, credit worthy. Their policies in some cases is that they won't even consider talking to the owners about lease renewals until they're within 3 to 6 months
Wow,
of the termination of the lease.
that's not
That's
much
not
time
very,
to plan.
yeah. When you are working like in our case with some of these larger ones, we're to the table about 2 years ahead of time. And because we've got so many properties with some, these stronger tenants, we do get a seat at the table and we can negotiate early. So we're having really good success on renegotiating. But you're right in that if that location that was originally bought is struggling, then tenant knows it's struggling and they're not going to be willing to give the same rent levels that they started with. And also, even though there's automatic lease renewals built into these, and those lease renewals may call for a 10% rent bump, that is at the discretion of that tenant, not at your discretion as the landlord. So if something has happened to that location that diminishes the value, then you could have trouble, and particularly have trouble if you don't have the economies of scale to deal with it. On the other hand, the good thing right now is that if you were in a property that was bought 5 years ago, it probably costs 50% more today to rebuild that property than it did to build that property 5 years ago. So it is really true that inflation is driving up building costs. And so you're finding that if you did your underwriting well in the beginning so that it's a viable location, we're not seeing tenants trying to go to other locations because they automatically are looking at rent bumps to move. So we're having pretty good success,
Interesting.
but it's where you buy, what's the demographics, what's the traffic count, what's the sales look like when you're doing that first buy. And there's no guarantee 5 years later that everything is still stable in that environment. It's kind of like all the riots and everything that happened around the country. Who would have thought? Now, well, I never bought in downtown San Francisco, but some of these regions of the country you never would have thought
Yeah,
that they would deteriorate.
right.
But you have to think about all of that stuff if you're going to buy property.
All right. Well, that's great. That you covered a lot, and that was a lot of really good information. I'm gonna probably cut and dice this up because there's a lot of good lessons learned there, Warren. I appreciate it, but some of the takeaways that I have from this is, and the lessons I've learned just from working with you and other net lease operators is due diligence is super important. Just don't just look at, hey, it's a Dollar General with a 10-year lease at a 7 cap. Sounds good to me.
Right.
I'll worry about it 10 years from now.
Yeah.
And then number two, you gotta be prepared with inspections and management because they're not going to take care of the property like you would. And so you got to hold them to that. And three, you got to be prepared for that negotiation at the end and with the bank or with the tenant because you're going to have to refinance during the term of the lease. And then you may not be able to enter negotiations till the very end of that lease, and that doesn't give you much time to prepare. All those things really convince me that unless you're an institution or have the considerable amount of wealth, net lease probably isn't the best option. I'd much rather go into a fractional ownership in a DST or a portfolio like yours where you're well diversified. Yeah, you're diversified across geography, multiple different tenants, and a couple dozen different properties. And then potentially a portfolio with $1 billion or more than $1 billion worth of these net lease properties where you can diversify the loans, diversify the leases, the tenants, and it obviously provides a much more predictable source of wealth and income, at least in my opinion.
I agree. Well, it's been nice talking to you today,
Yeah, you too,
Steve.
Warren. Thanks
Thanks
so
so much for
much.
your time.
All right, have a
Okay.
good one, Warren. See you next time.